Well, the entire crypto world, whether you're, in stable coins or whether you're a Bitcoin miner, Ethereum miner, they are all gathering in Washington for 2 days. And the reason they're doing that is it's the unprecedented number of politicians that are coming to that conference. And so there are panels on pretty well every. No, we're having a garden variety correction. Valuations got stretched. There was tremendous liquidity in the market. You got to remember, prior to the pandemic PPP programs and all the support in printing $4.5 trillion, this was standard volatility. It wasn't uncommon to have the VIX past 30. And we forgot about it. A whole generation of investors forgot or never learned what volatility was. Well, welcome to volatility. And now it's affecting many different sectors with the exception of energy, for obvious reasons, but each sector seems to get maligned every second week. And so the whole market's PE is being taken down with the uncertainty around inflation, Ukrainian war. And this has been talked about for weeks now, but there's no safety in saying I'm going to go hide in Walmart, for example. You just lost 20% there. That's because the market's trying to figure out what comes next. I've seen this movie so many times before. You need a big institution to go bankrupt. That always helps. I mean, you have to sacrifice an institution to get this to work, because then you get a dramatic flushing of equity positions as panic sets in. Margin calls are called in. Shorts, are bought. They basically bought themselves in already, and then you get this big leg down. Usually it's 5 to 10%, and that is the bottoming process we need. Now, this time I was thinking it might be in the crypto space. But that's already been decimated, and so it may be something else, a financial services company, or there was some rumors about Coinbase that turned out not to be true. But you need somebody's offside somewhere on a leveraged hedge position. You just don't know who it is yet, and they're big. And we're going to wake up in the next 10 days, 20 days, and you're going to find out they're a zero. That's a good thing, and I'm waiting for that to happen because we're getting close to a bottom. It usually happens in financial services where somebody was trying some strategy, a leverage strategy. It's always leverage that does this, or a hedge fund. Hedge funds, a good hedge fund that loses 10 or 20 billion, that's also good for flushing. And that's happened many times before. These are guys that, have never seen this kind of a market. So they set up a position that went awry, couldn't unwind their leverage, and they just get wiped out. And again, I feel sorry for them, but I think it's very healthy when that happens. And the trouble with this correction is it's a slow grind down 1 to 3% a day. And you don't really bottom till you get that flush. You only have to go back to 2020, 2021, when the height of the pandemic was ripping through the economy and people had tremendous fear. And not only was the Fed, trying to be very accommodative, but we were also printing $4.5 trillion. And so it's not a big surprise that you would have inflation now. That's what happens when you run the printing presses. It's unprecedented to print that much money ever in the history of our economy. And so having some inflation. Now, the big question now is what portion of it is transitory? Let's take a hint from what happened with Target and Walmart. Half of their problems were supply chain issues, the wrong mix of product, and increased costs of transportation. So it wasn't that the consumer rolled over and didn't want to buy anything. That wasn't the issue. The issue was they really had increased costs. In the case of Target, an extra $1 billion+ in just transportation. And so that really is something that's transitory. That's not going to be around forever. And so you have to kind of put that into the cake when you're talking about 6 to 8% inflation. Maybe 4 to 5% of that is real, and the rest of it is short term. And the market's kind of waiting to see which quarter we start to see that wane a bit, maybe come down to 7, 6%. I simply don't know. And nobody knows right now because it's really hard to read the tea leaves in this market. And so the question that everybody, including me, has every day when I see a correction like this, when I see Walmart down 20%, for example, which is a bellwether stock, if I'm an opportunist, I might put on a position. But what I'm doing right now is I'm waiting. I'm waiting for the big event, as I call it. And you get these events, and we talked about it. That day will be an interesting day to put 130er positions on. It'll be a day of panic. We'll be down somewhere between 2,000 and 3,000 points. And yeah, it's horrible to talk about it, but that actually is very healthy, very, very healthy. You get the PE of the market down into the 15 range, even lower, that's a tremendous buying opportunity. And I actually think earnings are going to be pretty good into the first and second quarter next year because we're still at full employment. And so, you know, all of these concerns and the Armageddon scenarios, and these are putting pressure and compressing PEs, but I haven't seen the downturn of the consumer yet. And so you need to kind of see that. Everybody's forecasting it, that's true, and pricing it into the stocks of consumer products and retailers like Walmart and Target, but they actually haven't seen it yet. People want to reallocate their currency, and right now, the US dollar is the safety trade. It is interesting to think about what that means because it should have shown up in a higher move in financials. JP Morgan would be a good example, yet the stock is down 20%. And so something's fishy, if you want to call it that. Strong dollar, higher rates, and financials turn down 20%. That's unusual. That's what I'm saying. This market is not yet finished trying to find its new equilibrium because nobody would have forecasted that. There were people just 8 weeks ago talking about loading up on financials and energy. Energy was right, financials was wrong. You basically made no money if you put those on equally. I think this is actually a maturation process for the crypto market. There's two basic baskets of crypto projects. One, highly speculative tokens, and you could say UST and Luna certainly fit that because they've been repriced dramatically. Highly unlikely in the context of stable coins will they ever return to their old prices because people have figured out a stable coin should be stable. And that means it has to be backed by something of asset value. You can note that USDC did not correct that way. In fact, during the period of this mass correction of other algorithmic or other quantitative or speculative stable coins that really got crushed, Circle, the company that issues USDC, was able to raise $200 million from Fidelity and $200 million from BlackRock. That's unprecedented in equity for the company. So that's signaling that that type of stable coin is favored by institutional investors versus the others, which look like they were retail products. So you've got all this speculative stuff. The NFTs have corrected. The Las Vegas side of crypto has had a nightmarish correction. And I think that's very good in the sense that it helps separate the wheat from the chaff, or the cream from the milk, if you wish, whatever analogy you want. Because the traditional projects have remained relatively stable. Sure, they've had a correction, but it's not uncommon each year for Bitcoin to give up 50% of its value, and that's certainly been the case here. Ethereum, same thing. And so that's the volatility that will be inherent in crypto until there's policy. I remain bullish on crypto from the perspective of productivity. And so I think if you're buying projects, and I've always said this, Bitcoin is not a coin, it's software. Ethereum software, Solana software, Helium software, Pollen is software. All of these different projects around different sectors of the economy. Solana may be better ultimately for transactional speed because Ethereum is pretty slow. So we don't know which one of these projects is going to win. But the whole premise is that you want these for financial services. And I still believe that in 10 years, crypto will be the 12th sector of the economy, but all the existing tokens will not exist. There'll be many that just go to zero because they were highly speculative, they were fun, they had no real intrinsic financial services value. But if you were to ask me about USDC and say, look, where's the value of that? Well, first of all, you can stake it or loan it at a 4% rolling annualized yield every 30 days, and that's valuable in inflationary times. Secondly, it is a highly effective payment system because I am now accepting payment for goods and services in USDC, and very often not converting it back to fiat because I'm simply leaving it in my Circle account and rolling it into these 30-day contracts. I think what's going to happen first is we're going to see policy on stablecoins, and both the Haggerty bill and the Toomey bill are very clear about what they want in the regulatory environment on stablecoins. They want a 30-day audit in both cases, and they want all the underlying assets to have duration of less than 12 months. And that makes sense to me. And I think once they put that law into place, which is an easier bill to pass after the midterms, nothing's going to happen until after the midterms. Biden is not interested in discussing crypto when his poll ratings are, whatever it is, sub 31%. That's not a place he wants to go. The market's correcting. Biden's facing, close to double-digit inflation. People are getting gas at the pump going into the driving season at unheard of prices the last 20 years. The price of protein's up 20 to 40%. He's not sitting around worrying about crypto. So you got to think that through in terms of policy. So nothing's really going to happen. Plus, you've got a lot of different proposals coming out of the SEC around climate change and crypto and Bitcoin mining and all that stuff. So it's a very volatile situation. Well, the entire crypto world, whether you're in stable coins or whether you're a Bitcoin miner, Ethereum miner, they are all gathering in Washington for 2 days. And the reason they're doing that is it's the unprecedented number of politicians that are coming to that conference. And so there are panels on pretty well every topic. This is a lobby group that lobbies for the crypto industry. You've got legislation banging around in New York legislature that would ban proof of work, even in a state that has abundance hydroelectricity, which seems ludicrous. So, there's a lot of discussion around not just Bitcoin mining, but data centers. I mean, the new oil is data, and every jurisdiction globally wants to have their citizens' data on their own land now, after what happened in the Ukraine. So the Canadians have moved their DocuSign servers into Canada. Many other countries like Ireland are doing the same thing. So you have this huge demand for data centers, and most people do not want them built off coal-burning electricity. They want them built off hydropower, and they want them built off nuclear power. But the biggest problem we're having right now is getting access to semiconductors to build out these data centers. There are none. And so you have to really partner with some of the Middle Eastern countries that have ownership of semiconductor manufacturing to build anything in data centers now. So it's getting complicated. The forecasts of Bitcoin have never been accurate. No one's been able to forecast its volatility. And the speculation that it was going to be a hedge against inflation was just flat out wrong. And that didn't work. And maybe it will work one day, but I'd argue that the volatility on Bitcoin is going to remain very akin to what Amazon was for its first 15 years, 30 to 50% corrections every 12 months, because there was no institutional support in the early days of Amazon. It was a retail product as people started to use the service, bought the stock. That's the same right now for Bitcoin. There is no, people talk about institutions owning it. That's just not true. They don't own any of it, and they won't until the SEC rules on it. There is some institutional ownership in the Canadian market by Canadian institutions because they can use the ETF and equity mandates, but that's Canada. They were the first to allow an ETF with Bitcoin as the underlying. They also allowed an Ethereum ETF, and so those are positioned, but they're inside of equity mandates. The actual ownership of Bitcoin itself remains elusive to the institution because of their own compliance departments. And on top of that, no infrastructure for compliance. There's no way to market into any of these systems the price of Bitcoin or whether it's levered or not during the day, the way you can with stocks that have been treated that way for decades. So there's so much work to be done.